Good morning. In tennis, every player must balance avoiding unforced errors with a mix of offensive play that is trying to score winning shots. I believe the tennis analogy applies perfectly to investing. Ben Graham, the father of value investing, coined the very famous phrase, the margin of safety. But what the margin of safety misses is a balance, just like in tennis. A balance of, for lack of a better word, trying to avoid errors of omission. A lot of investment managers talk about the margin of safety. The idea that they purchase things so cheaply that even if there's an adverse development in the investment thesis, they will still break even on their investment. But far fewer people talk about the errors of omission. And the errors of omission are simply an insidious error, which means losing out or missing out a great opportunity. And I call it a very insidious error because it doesn't show up directly in your P&L. You don't see the points that you didn't score. You don't see the gains you didn't make directly in your P&L, but you see the losses you made very clearly. And as a result, I think most people overemphasize the margin of safety and don't spend enough time on avoiding errors of omission. So with that, I think there are at least 4 reasons why people commit errors of omissions. Number 1, there's a lot of anchoring going on. They see a stock at 20, it goes to 30, and they feel they missed it. They wanted to buy it cheaply at the bottom. Secondly, I think there's a lot of career risk. It's very hard to be fired or face scrutiny over a missed investment opportunity, especially if your partners or other people in your firm don't even know that opportunity existed. Third, I think there's a behavioral issue happening. Most people are really afraid of losses. Losses hurt much more than gains that you forgo. And finally, I think there's a lot of vanity going on. I think a lot of self-professed value investors love to talk about being disciplined and how they never overpay and they have this discipline to the margin of safety and they never stretch, they never pay a premium valuation for a high quality company. But the truth is that in investing, the vast majority of your returns will come from a handful of investments that will be able to compound at high rates of return for very long periods of time. So missing out on just a few of these great potential investments can really dramatically alter your investment track record as an investor, as an investment manager. Ben Graham, the father of value investing, has really coined the term margin of safety. But what people miss and often forget is that Ben Graham investment partnership, his investment firm, he had an investment in Geico early on. And that single investment accounted for more than half of all the investment gains that he made. And yet this is something that is not taught nearly as much in the value investing community, and it's not emphasized enough. So without that, if Ben Graham had missed investing in Geico, his investment track record would have been dramatically different. So while investors rightfully focus on the margin of safety, they need to also focus on avoiding errors of omission. So with that, thank you for listening today. And I look forward to hearing from you and discussing with you how our investment process, our portfolio execution at LRT is specifically set up to avoid the errors of omission. Thank you, and I look forward to hearing from you.